Hello, everyone. So topic 7, derivatives, my favourite topic. Here's the lecture notes. And here on the right, you can see CBOE XBT, the first US Bitcoin futures now available for trading, but they didn't last long. They stopped trading about nearly 2 years ago, actually. Well, 1.5 years ago. I think it was in April 2019. All right, so there are 5 parts, no Excel spreadsheet, so just 5 videos. This first one is very short. I'm just going to introduce derivative, what they are, swaps, futures and options, and talk a little bit about crypto derivatives exchanges. That's it. So derivatives contracts are based on a notional amount. So you don't have to have all that money to trade. If you want to trade a position that's worth 100 million, you may only need 1 million to trade it. And that's because either you are just receiving interest or some cash flows linked to that notional amount. So you're never actually going to be trading the notional anyway, it's just notional. Or it could be the value of, for example, a futures contract or an option underlying. And so with a futures contract, you would only have to buy, if you went long a futures, if you held it all the way to the date of expiry. And so you trade on a margin until that date, you see. And that's why it's a notional amount for the futures. And in derivatives contracts, there's always 2 counterparties, a buyer and a seller. So in a swap, we might say payer and receiver. If, for example, on an interest rate swap with some notional amount of, say, 10 million, one person could pay LIBOR, that's a floating rate, and receive 2%. And the other person would be the other way around. They would receive LIBOR and pay 2%. So in a swap, it's not quite clear who the buyer and seller is, but with a futures or an options contract, you can go long or short. So you can go long a futures. That means you buy the futures contract. I'll tell you more about details of these contracts as we get through this topic. And seller is going short. So there's 2 sides. That means that the market capitalization is always 0. So it's different, obviously, in share markets when, if I buy a stock and lots of other people buy stocks and you add up all the value of all those stocks we hold, that's the market cap. It's still possible to short stocks using something called repo, but I'm not going to go into that in this. It's not really relevant for crypto derivatives exchanges. So derivatives contracts are either traded over the counter. That means 2 lawyers get together and they have some contract. And most of these contracts are based on standard terms and conditions. The International Swaps and Derivatives Association, that's ISDA, ISDA, they have lots of sort of standard format for these contracts. So if you do enter an over-the-counter agreement, then you'd use an ISDA contract most likely. Or they're traded on an exchange. And for crypto derivatives, we know that there are 2 types of exchanges, the centralized exchanges and the decentralized exchanges. And different types of derivatives are traded on centralized and decentralized exchanges. Now, swaps in general are mostly traded over the counter. And this notional amount just determines cash flows between 2 counterparties. So we'll be looking at swaps that are traded on, the equivalent to over the counter is on chain. And these decentralized exchanges are collections of nodes on chain. But the swaps that they deal in, mainly on swaps, can be anything from asset swaps to more advanced interest rate type swaps. Futures are traded on exchanges in every market. So, S&P futures are traded on the CME, FTSE futures are traded on Eurex and so forth. It's the forward contracts that are OTC. So foreign exchanges mainly on forwards, and that's traded over the counter in the London markets mainly. Now, on an exchange, you have people called market makers, and these are like the stall holders in a market, like the lemon sellers, as I said before. And so they buy and sell lemons. They make the market in lemons. And they can be long or short at the end of the day. They can have lemons to take home, or they could have orders to sell lemons that they don't yet have. So they can, at the end of the day, their book may not be balanced properly, in which case in standard markets, you have to do some hedging overnight so that your risk is mitigated in case when you come back the next day, the price of lemons is completely different. But on the cryptocurrency derivatives exchanges, trading is 24/7 and very, very active. So hedging of market makers is a bit of a different issue. And anyway, these exchanges are so new so that the problem of hedging is still very much in its infancy. It's actually something that Arben's getting onto in his second paper. So the options, they can be either over the counter or on exchange. More complex options are over the counter. They could have all sorts of weird payoff functions, but we're just going to be looking at standard European options, and these are exchange traded in standard markets and also on crypto markets. Okay, so looking at the main derivatives exchanges in crypto, this is from the Crypto Compare Exchange Review that we looked at in the last topic. You can see that on the right-hand side, as of November here, the most active crypto futures and options exchanges were Binance, Huobi, BitMEX, OKEX, Deribit. And that the volume, the black line here, that's traded on derivatives has been growing, whilst that on spot markets has been going down. So at the moment, there's more, about 60% of trading is on derivatives, and only 40% is on spot. And within the derivatives, Binance, Huobi, and OKEX and BitMEX have by far the largest share. That's Binance is green, Huobi is black, BitMEX is pink, and OKEX is blue. The light blue CME, that's the only regulated exchange for Bitcoin futures. They don't do Ether futures or any other futures, or they do options, but they've only just started doing those. But their volumes are very, very low compared with Binance, for example. Now, let me just show you the, for example, this is Huobi. No, this is Binance, okay? And this is live. And it's a very exciting time because I've got a limit order to sell Bitcoin actually against the euro. And it's been, well, you can see what's been happening over the last few days. This is the 8th of November, 9th of November, 10th of November. And things started to hot up yesterday, and this morning it's really taken off. And I thought at 2 p.m. that it would be sort of, the US would come in at 2 p.m. and things would start going down a lot, but actually they haven't. So this is the Binance Bitcoin futures against the dollar. This is the OKEX interface. I haven't logged in, so I can't see what that's doing, but you can see that it's going up still on this little chart here. And so this is being updated live. This It's 5% over the last 24 hours that the return is. Leverage, that means how much margin on these contracts. So it's 10 times leverage. So one contract costs $17,277 for one Bitcoin. And so that would be a 10 times leverage margin. So it'd be 1.728, 1,728 or so. It's changing all the time, so it's difficult to keep up. If you look at the different types of orders, mine is a limit order, not on this exchange. And there are different types of orders. You could have a stop loss. I think I explained those orders in the last topic. You can order at market rather than the limit book. I didn't explain about trigger orders or trail or iceberg. And trigger, you look for a sign that's a trigger to put on your order. So something has to happen first and then you put on your order. That's a trigger order. An iceberg order is when you've got a very large order. If you make a huge order, it can move the market quite a lot and change the market price. So to prevent that happening, you can break it up into little amounts. That's an iceberg order. Advanced limit orders have, let's have a look at the details of these orders here. This is probably one of the best things about different types of orders if you are interested. So they illustrate exactly how to put on your limit orders or a stop order or so it's really, really nice little tutorial there with Binance, with OKEX, I think it is, yes, OKEX. Now this is the book I'm trading right now, and my position is 14,774. So I think I might hit it by the time I finish this topic. We shall see. In which case I exit Bitcoin for a bit, probably for quite a long time. Anyway, it doesn't look like there's too much spoofing going on. This is Coinbase, of course, and that doesn't have spoofing. But if I look at this order book, for example, let me see, can I see it a bit better? No, it's not showing me how to do it. Let me have another look. If I can look at Ether, for example. If it'll allow me to go and have a look at the book in there. No, you can't see the book unless you log in or register. You can only see the price evolution. What about Huobi? Let's see. It's interesting, these turnover and volume reports, because they tell us how much speculation is going on. Huobi is one of the worst. So they really trade very, very quickly, which shows that there's a lot of speculation going on there. Let me see if I can get past this slick site, if I can see the book. You see, what I want is this visualization of the order book that you can see here. This old interface that Coinbase inherited from GDAX is really nice. I'll show you later on anyway. In BitMEX, you can see the book. Also in Deribit when we look at options. All right, I think that's it for the first video. There's nothing much else I need to say. So let me stop share and end the video.